Hello and welcome to this Candlestick Charts video brought to you by Drift Protocol. So Drift is a lightning fast and scalable perpetual futures DEX on Solana. If you haven't checked it out yet, please do. You can trade BTC, Ethereum, Luna, and more recently Atom. A quick disclaimer, this video is not financial advice. Neither Drift nor Xerox Nemisa are financial advisors. This video is for entertainment purpose only and trade at your own risk. As a quick summary, we'll talk about the origin of candlesticks, its components, volume implications, and we'll talk about liquidity, candlestick patterns, chart formation, and we'll have a quick outro on footprint charts. So in terms of origin, candlesticks were either developed in the 18th century by Muneisa Honma or in the late 1800s, depending on the source. There's actually debates about that. And what happened initially is that there was a coupon-based futures market for rice that started in the early 1700s in Japan. And there was also a secondary market regarding this coupon, so people were like trading them on the secondary market. Candlesticks are essentially a representation of price movement for a specific asset within a given period of time. And today they're used mostly to perform technical analysis on stocks, forex, commodities, and crypto. So on the right, you have a very brief example on, Solana price action with candlesticks. So regarding candlestick components, first we'll define two types of candles, the bullish candle and the bearish candle. Both of them are 4 levels, so the open, the close, the high, and the low. What's important to remember is that for bullish candle, the close is above the open because we went up during the session, during the trading session. And we define also 2 other levels, the high and the low in the session. So for example, we could have open here, go all the way onto the low here, tap the high, and then close here, right? For a bearish candle, we have the open still, the close here, the low and the high. So same 4 levels, but the main difference is the close is below the open because we went down during the session. So for example, we could have opened here, tap the high here, go all the way low here, and then push back up and close here. So bullish candle, we go up during the session. Bearish candle, we go down during the session. One quick note is that in some regions, people use different color codes with red for bullish candles and green for bearish ones. There's a reason for that, but I won't get into details today. In terms of volume implication, so volume is a key component of the auction market theory with price and time, and volume essentially allows qualifying whether a market is being efficient or not. So let's take a quick example. Imagine a seller selling an item at $0.5 and there's a lot of buying demand for this item at that price. So naturally, the seller will try raising the price to $1, for example. So while there's still, buyers stepping in at $1, we can see that volume is starting to decrease. Still, the seller is satisfied and is gonna try to, push the price to $1.50. So he's gonna start selling this item for $1.50. And what happens here is that literally you'll have no buyers. And this is an example. But what will the seller have to do is to lower the price again to come back to a level where it's being supported by volume. So with a high volume, high buying volume at the new level. And this is what we call an efficient setup. So volume is very important to qualify whether a market is being efficient. And we see that in trading in general. The beginning of trends are often very highly supported by volume, and then we'll see sometimes at the end of the trends that volume is decreasing significantly. So this could signify that we've reached the top. So essentially, volume trending up could signify the beginning of a trend, and volume trending down could signify the end of the trend. It's not always the case, but that's a good rule of thumb to keep in mind. In this example here, we had the price slowly grinding down, trending down, and we see also that the volume is going down. So naturally, what that implies for sellers is that the price is getting too low for sellers to sell. And so if I'm a seller, I'm going to want to sell a higher price. So sellers are drying up at this level and naturally will have a reversal happening. In terms of liquidity, what I want to emphasize here is the difference between impulsive candles and kind of efficient price action. So impulsive candles, like so for example, here on the left we have this big, very long candle that went from about 138 to 143. So this very impulsive move usually creates inefficient price action or illiquid zones, and the reason for that is that they spend very little time on those levels in between the high and the low, or the open and the close, and very little time, and volume is distributed at this level. So naturally the market wants to be efficient, and what the market will do is that it will come back to this level and distribute time and volume. So that's what mentioned here. These areas tend to be revisited for time and volume distribution. It doesn't mean that the revisiting is gonna happen right away, but when you see impulsive candles like that, it should be a warning sign that at some point there may be a pullback coming in. So the market being cyclical, efficient distribution leads to imbalance and vice versa. So we have an illiquid move here, we come back down, distribute volume and time. Another illiquid move here, we come back down, distribute volume and time. Another example in AVAX. So AVAX, we see an illiquid move down, and we come back to the level, distribute time and volume, and then we come back to an imbalanced environment. Another example with bend on the 1-day time frame. This is to show you that not only works on smaller time frame, but this is applicable to every time frame, whether it's the 5 minutes or the 1 day or the weekly and so on. And here we have actually a move from like $5 to almost like $14 here. So this is kind of a big move. But what happens, illiquid zone created by the price action, and then the market comes back, distribute times and volume, and retest the zone, and then we go back up. And what we see here on the volume profile on the right, sorry. So the volume profile is essentially volume distributed by price level. We see that in this consolidation right here, we have a big distribution. If you take that out and kind of like replay this whole move without that consolidation, you won't have this volume distribution, and you will have this a kind of gap here. But so this should hint you at a potential consolidation coming to actually fill that gap that was present before this volume distribution. So regarding candlestick patterns, what we want to emphasize here is that learning every single one of them is not necessary. You should focus on context and confluence instead. And here, if we take the example of Phantom, we have two patterns. Number one, we have a bullish engulfing candle, and number two, we have a gravestone doji. The bullish engulfing candle is a bullish pattern and should, kind of lead you to long in a way, but there are a few factors to consider on the chart that should lead you to conclude that it might not be a prime opportunity. So for example, here we have number one, a low volume node. So low volume node are areas of very little executed volume, and they typically act as support or resistance depending on context. So here it's obviously resistance. Number two, we see that as we go close to the gravestone doji, we have decreasing volume. So we have a high, a high, a high, and then we see that the volume is decreasing at the same time. Same thing with the oscillators. We have a divergence, a bearish divergence right here, and we can see the same thing on the unbalanced volume. So you have like three types of divergences here, plus the fact that in terms of price action, we're reaching a low volume area. So this should lead you to conclude that it's not necessarily the best place to long. The gravestone doji, though, when you see that patterns happening with a confluence of indicators, volume, and price action, then you should conclude that it might be a good idea to short instead. So really, it is important to place all those candlestick patterns, not look at them as single candlesticks or just like one or two or three candlesticks, but have a overview of what happened before and what's mostly gonna happen after. In terms of chart formations, so instead of looking for isolated candlestick patterns, it's indeed better to identify chart formations because they offer more context, because those chart formations actually composed of multiple candles. So here we have an example on band again, and we are looking at a over-under pattern, which is a reversal pattern that can be tradable on any time frame. So we have first a downtrend here and printing a first low that is later broken, and then we go back up, back above this low, and kind of retest it through a rounded retest, and then we start trending up. So this type of chart formations is quite interesting because they're not isolated patterns, and they offer a lot of context in terms of what happened before and what's likely to happen next. Other chart formations that you could look into is double, triple bottoms or tops, cup with handle, and rising, falling wedge, and so on. As an outro to this video, we're going to talk about footprint charts. Footprint charts are great because they provide details regarding market orders executed within candles at each level. So for example, here we have on the left market sell orders and on the right market buy orders. It's all executed orders already, with a volume of 59 million and a delta of minus 9.3 million. Delta is just the difference between market buy orders and market sell orders. Footprint charts will allow you to detect things like trapped participants on the wrong side of the market. For example, here in orange, we have what we call imbalances. Imbalances that just highlight when either the market sellers or the market buyers are getting too aggressive versus the other side. So here we have a clear aggression of market sellers, and contextually we see that they're started to get aggressive within a candle wick. So we could potentially deduce that these guys are on the wrong side of the market and that those shorts are trapped. And so what will happen next is that pretty often the market will retest this, like the beginning of this like stacked imbalance as a support. And what we'll have here is that the shorts that were trapped will start closing their shorts at break even or at a loss, and the buyers will start defending the level and will have fuel to go higher. So this could be a potential entry. As a conclusion, So candlestick charts are the most widely used representation of the markets. Trading isolated candlestick patterns is definitely not something we would recommend because they don't offer, context and confluence. So instead, you should look at chart formations that is preferable as patterns to trade because they're composed or several candlesticks. Also, we talked about liquidity, and what's interesting is that impulsive candles, when you start noticing them, they can be an edge that will lead you to anticipate more a pullback and distribution of time and volume because this candles created inefficiencies. And then finally, we talked about footprint charts. Footprint charts, they're also very useful in when you look at the right context, and they provide an additional edge because they display volume execution within each candle. So thank you for watching this video, and we'll see you soon.